So you want to start investing, but you have no idea where to begin. You have heard people talking about stocks, ETFs, brokerages, expense ratios, and it all sounds kind of overwhelming. I get it. I was in the same exact position back when I first started. That's why in this video, I want to strip all of that away and walk you through every single step. From why investing matters, to what you should actually buy, to actually showing you how to place your first trade. And by the end, you will have gone from zero to actually owning your first investment. So with that being said, let's start with the most fundamental question. Why invest? Even if you are using a high interest savings account like UOB1 or OCBC 360, you are still looking at around 2 to 3% on average. And that's if you jump through all the hoops. Meanwhile, Singapore's average inflation over the past 30 years has been about 1.6%. This means that even with the best savings accounts, your money is still barely keeping up. On the other hand, if you look at something like the S&P 500, which tracks the 500 largest US companies, it has averaged around 8 to 10% annualized returns over the long run. So here, I have two lines. Both start with $10,000. The green line is the S&P 500 at 10% return, and the yellow line is a savings account at 2%. And both lines are adjusted for 1.6% inflation. At year 5, the lines are still pretty close. Your savings has about $10,120 in real terms, and the S&P 500 is around $12,800. Not a big difference. At this point, you might look at this and think, what's the big deal? But watch what happens as I drag this slider further out. At year 20, the S&P 500 has pulled away to about $50,000 in real purchasing power. Meanwhile, your savings has barely moved to around $10,831. In other words, your savings has gone nowhere after inflation. And notice how the green line isn't growing in a straight line. It's accelerating. That's compound interest, where your returns start generating their own returns, which will then generate even more returns. So if we go all the way to 40 years, that compounding just takes off. The S&P 500 has grown to around $251,867 in today's money, while your savings account sits at just $11,731. In other words, keeping your money in a savings account isn't playing it safe. That's $240,000 gone, and that's just from a one-time $10,000 investment. Now imagine what the gap would look like if you're not just investing once, but every single month for decades. That gap could easily be the difference between retiring at 50 and still working at 65. That is 15 more years of waking up to an alarm, or 15 more years of someone else deciding how you spend your day. That's because not investing doesn't just cost you money, it also costs you the one thing that you can never get back: time. So the question isn't whether you can afford to invest, it is whether you can afford not to. Okay, so now we know that investing is important, but here's the thing that scares most people. The market can go down, and nobody wants to be that person who puts their money in right before a major crash. So they think, maybe I should just wait for a better time to start. But here's what the data actually shows. Here, I compared different strategies using 20-year rolling returns across almost 100 years of market data. The first is immediate investing, where you just put your money in right away whenever you got it. The second is progressive crash buying, where you hold your cash patiently and only invest in increasing amounts when the market crashes. And the results, immediate investing wins 91.4% of the time, outperforming crash buying by an average of 22.9%. Meanwhile, the crash buyer only wins 8.6% of the time, and even then, he wins by a measly 1.5%. This is the same for DCA, where you invest a fixed amount every month. DCA beats the crash buyer 86.4% of the time by an average of 20.5% outperformance. And when crash buying does win, it only edges ahead by about 2%. This actually makes sense when you think about it. The stock market goes up roughly 70% of all years. So if you are sitting on the sidelines waiting for a crash, chances are the market is going to continue climbing and your cash is just losing to inflation. Then by the time a crash finally comes, the market has often already risen so much that even the crash price is higher than where you could have bought in a few years ago. Or in other words, time in the market beats timing the market almost every single time. So then, how much money you should put in to what big? Before you put a single dollar into the market, you need to sort your money into 3 buckets. The first bucket is your short-term savings. This is 3 to 6 months of living expenses, kept somewhere easily accessible like a high-interest savings account or a money market fund. This is to cover your daily expenses and any unexpected emergencies that might come out, such as a job loss, medical bills, or unexpected repairs. You need this money liquid and safe at all times, so don't invest it. The second bucket is your midterm savings. This is the money that you know you will need in the next 1 to 5 years. Things like your BTO down payment, a wedding, a car, or a wife. You don't want this in stocks because if the market drops 30% right before your wedding, your partner might run away. Park this somewhere safe like T-bills or Singapore savings bonds. And lastly, the third bucket is for long-term savings. This is the money that you won't need for 10 years or more. And this is what you can invest in the stock market. So how much should you put into your long-term savings? As much as possible lah. But seriously, don't overthink the number. Once the first two buckets are covered, you can just invest whatever that is left over. $100 a month? That's fine. $500? Even better. The exact amount matters way less than just doing it consistently. Because someone investing $200 every single month for 20 years will almost always beat someone who keeps waiting for the right time or the right amount to start. Now, let's talk about what you can actually invest in. First up, individual stocks. When you buy a stock, you are essentially buying a piece of a company. So think of a company like a pie with 10 slices. Each slice is a share. If you buy 3 slices, you own 30% of that company. So if this company is worth $100,000, your 3 shares are worth $30,000. And if the company grows, the pie gets bigger, and your 3 shares are now worth a lot more. Sounds simple enough, right? But here's the thing. To actually pick the right stocks, you need to understand things like earnings reports, PE ratios, balance sheets, industry trends, and macro conditions. Now, you might be thinking, but what's so difficult about that? Can't I just buy the obvious winners like Nvidia, Google, and Apple? These are the biggest and best companies, and they aren't going anywhere, right? Well, that's exactly what people used to say about companies that seem too big to fail, and yet they all fell apart. Nokia once had 50% global market share in mobile phones before the iPhone came along and made them irrelevant almost overnight. General Electric was once the most valuable company in the world, but years of bad acquisitions and hidden debts brought it crashing down. Kodak literally invented the digital camera, but ended up going bankrupt because they were too slow to adapt. And it's not just individual investors who get it wrong. According to the data, over the long term, about 90% of professionally managed funds underperform the S&P 500. These are people with teams of analysts, Bloomberg terminals, and decades of experience. And yet, most of them still can't beat the market. So what do you do instead? Rather than buying individual stocks, you buy all of them. Because you won't buy the wrong stocks if you buy every stocks. That's basically what an ETF is. An ETF is a basket of companies put together based on certain rules. For example, the S&P 500 is a basket of the 500 largest US companies. When you buy an S&P 500 ETF, you are buying a small piece of all 500 of those companies all at once. So even if a few companies do badly, you won't get wiped out the way you would holding a single stock. Essentially, ETFs give you diversification gao. On top of that, ETFs are self-cleansing. So when a company does badly, it gets removed from the basket and replaced by one that's better. Because of this, ETFs will naturally evolve to always hold the strongest companies at all times. For example, back in 1900, the US stock market was dominated by railroads. That was the tech of that era. By the mid-1900s, it shifted to industrials and banks. And today, it is technology companies. If you had tried to pick the winners in the 1900s, you would have probably loaded up on railroad stocks. And most of those companies don't even exist anymore. But if you had just owned the entire market through an ETF, you would have automatically shifted from railroads to industrials to tech without doing a thing. That's the power of an ETF. It gives you exposure to whatever the future turns out to be, without you having to guess what that is. Now, of course, stocks and ETFs aren't the only things you can invest in. There are also bonds, unit trusts, and more. But for this video, we are going to focus on just ETFs because for most beginners, they are the simplest and most cost-effective way to get started. Alright, we now know ETFs are the way to go. But which ETF do you actually buy? There are broadly 3 categories you should know about: the S&P 500, the Global ETF, and the Singapore Focus ETF. Let's start with the S&P 500 ETF first. As mentioned earlier, S&P 500 tracks the 500 largest companies in the US. If you believe the US will continue to dominate the global economy, this is the ETF that you can invest in. There are many S&P 500 ETFs out there, such as VOO and SPY, but they are all domiciled in the US, and that's a problem because US domiciled ETFs come with 1. 30% dividend withholding tax, which means for every dollar of dividends you receive, 30 cents goes straight to Uncle Sam. And 2, there will be up to 40% estate tax on your holdings above $60,000 US if you pass away. Who say bo? Then how? So the workaround is to buy Ireland domiciled ETFs instead. There's no US estate tax and the dividend withholding tax drops to just 15% thanks to the Ireland-US tax treaty. Oh, and by the way, Singapore itself doesn't charge any capital gains tax, so you also get to keep 100% of your investment gains. For this, my pick would be SPYL. It is Ireland domiciled, so lower dividend withholding tax and no estate tax. It is an accumulating ETF, which means your dividends automatically get reinvested back into the fund, so you don't have to do anything. And the expense ratio is just 0.03%, which is incredibly low. For comparison, CSPX, the other popular Ireland domiciled S&P 500 ETF, charges 0.07%, which is more than double the cost. Now, while the S&P 500 has been on an incredible run, that hasn't always been the case. The UBS Global Investment Returns Yearbook has this chart that shows how the world's stock markets have shifted over the last 125 years. In the early 1900s, the UK was the world's largest stock market, back when the British Empire was at its peak. By the 1980s, it was Japan. Their economy was booming so hard that the Imperial Palace in Tokyo was reportedly worth more than all the real estate in California. And today, it is the US. This tells us that every era has a dominant market that it feels like it will last forever, and yet it never does. In fact, during the 2000s, which Wall Street calls the lost decade, the S&P 500 returned negative 1.36% annualized over 10 years. Meanwhile, a global ETF returned positive 1.65% over that same period. And that's where a global ETF comes in. Instead of betting on one country, you buy the entire world. And that is useful because if ever the US slows down one day, but some other region like Europe or China takes off, you are already invested. Again, you don't have to predict which country wins next because you own all of them. For this category, my pick would be ACWD. Again, it is Ireland domiciled, accumulating, and it holds roughly 2,900 stocks across 47 countries. With just this one ETF, you own almost the entire world economy. It already has about 60% US exposure, so you are not missing out on US growth. And the expense ratio is just 0.12%. This is cheaper than all the other global ETFs out there, such as VWRA at 0.19% and FWRA at 0.15%. The third option is a Singapore-focused ETF, like ES3 or G3B, which tracks the Straits Times Index. It hosts Singapore's top 30 companies, such as DBS, OCBC, Singtel, and CapitaLand. While many Singaporeans like to invest in this category, personally, I feel that this category is optional, and here's why. Singapore makes up about 0.3% of global market cap. So even if you have 10% allocation to the STI, this means you're overweighting Singapore by 30 times. Professor Elroy Dimson, who co-authored the UBS Yearbook and co-created the UK's FTSE 100, has said that investors should avoid home bias because as Singaporeans, we are already heavily exposed to the local economy through our jobs, our property, and our CPF. So it will make sense to diversify elsewhere. But if you like the comfort of SGD dividends and owning local blue chips, there's nothing wrong with that. Just know that you are making a deliberate bet on Singapore, which may increase your concentration risk. So those are the three main categories. But which one should you actually go for? If you want broad exposure to the entire world economy, just go with ACWD. Or if you believe the US will continue to lead, you can go with SPYL instead. And of course, you are not just limited to just one. You can always mix and match. Maybe 70% ACWD for global diversification, 30% SPYL to tilt toward US growth, or throw in some ES3 if you want Singapore dividends. Feel free to play around with the allocations until you find a mix that you are comfortable with. Because at the end, the specific ETFs that you invest in aren't the most important thing. What matters more is that you pick something and stick with it for the long term. Next, let's talk about where you can actually buy them. In Singapore, there are two kinds of brokers, CDP accounts and custodian accounts. With a CDP account, shares are held directly in your name at Singapore's Central Depository. This means your shares aren't tied to any one broker. You can access them from any CDP link platform. And because the shares are registered under your own name, you get perks like AGM invitations, voting rights, and sometimes even free meals. While this is super convenient, the downside of CDP brokers is that their trades can be rather expensive. We are talking $10 to $25 per trade, which will add up quickly if you are investing often. Meanwhile, with a custodian account, your shares are held in the broker's name on your behalf. For example, if you buy shares through Broker X, those shares live inside Broker X. And if you buy shares through Broker Y, those shares live inside Broker Y. Then, if you ever need to sell your shares, you will need to go back to the respective brokers to sell. The trade-off is that with a custodian account, trading fees are much cheaper, as low as $1, or sometimes even free. But if you are worried about safety, no worries. Even though your shares are kept with the custodian broker, MAS requires all Singapore brokers to keep your assets in segregated accounts, separate from the company's own money. So if the broker ever goes under, your assets are still safe. This means for most beginners, a custodian account is the most cost-effective way to go. CDP only really matters if you are buying Singapore stocks and wants the flexibility to access your shares across different brokers. Next, let me walk you through a few popular brokers. First, Interactive Brokers or IBKR is probably the most widely used brokerages among Singaporean investors, and for good reason. Their trading fees are some of the lowest around. We are talking as low as 35 cents per US trade. They also give you access to almost every market in the world, including the London Stock Exchange, which is important because that's where you'll find those Iron Domicile ETFs like SPYL and ACWD. The platform can feel a bit intimidating at first, but once you get the hang of it, it is hard to beat. Next, Moomoo covers markets like the US, Singapore, and Hong Kong, with fees going as low as 99 cents per trade. What makes Moomoo stand out is how beginner-friendly it is. Clean app, built-in AI research tools, and they've even opened physical stores in Singapore if you ever need help in person. They run frequent promotions like welcome rewards and trading competitions. And they have two standout features, CDP link trading for Singapore stocks, which is rare among low-cost brokers, and a built-in money market fund, so your uninvested cash earns interest while it sits there. Last but not least, IG Markets. This is a fairly new share trading app, not to be confused with IG Trading, which is their CFD platform. IG Markets offer zero commission across all their markets, plus they pay you 3% interest on your shareholdings up to $50,000. The cash, there's a 0.7% FX spread on currency conversions, which makes it expensive for US or global ETFs. But for Singapore market trades where there's no FX conversion, it's effectively free. These are just a few of the options out there, and each has its strengths. At the end of the day, just pick one you're comfortable with and get started, because the broker matters far less than actually getting started. Now, let me actually show you how to buy your first ETF. I'll be using Interactive Brokers for this demo, but the steps are basically the same as on any other platform. So here, I'm on Interactive Brokers. Before you buy anything, you need to make sure you have the correct currency. For example, if you have SGD and you need to buy a US denominated investment, you need to convert your SGD to USD. To do that, tap on the menu icon on the top left, transfers, then convert currencies. Select your base currency and the currency that you want to convert to. For example, SGD to USD. Then enter the amount. Once you are done, you can then search for the investment that you want to invest in. For example, let's try ACWD. You will see multiple listings, so make sure you select the one that says LSE ETF, which means the London Stock Exchange. Then tap on Buy. For quantity, if you tap on the down arrow, you can switch between buying in number of shares or in dollar amounts. Sometimes I like using the dollar amounts because it lets me easier understand how much of that money that I'll be using to buy. So let's try buying $500 worth of shares. Next, you will need to choose your order type. A limit order lets you set the price that you are willing to buy. So if I set $280, this means the trade will only go through if the ETF drops to $280. Meanwhile, a market order lets me immediately buy the ETF at whatever the current price is. For beginners, a market order is often the simplest. Once you are done, you can preview the order, and if everything is okay, you can just slide to submit the order. And once the order is fulfilled, congratulations! You have just completed your first investment, and you are now a proud owner of 2,900 companies across 47 countries. Now, here's the part most people get wrong. Investing isn't about buying, it's also about staying invested. So let me share a few tips that will help you in the long run. The first and probably most important is to automate your investments. Most brokerages now offer a recurring buy feature where you can set up a periodic auto purchase of your chosen investment. For example, on IBKR, you can open the investment that you want, tap on the three dots on the top right, and select recurring investment. From there, just set how much you want to invest and how often, and the broker will handle the rest. This removes all the temptation to wait for a better price or second guess yourself, because the whole point of DCA is that you invest consistently regardless of what the market is doing. And that is probably the single best thing you can do to stay on track. Second tip, and this is also the hardest one, is to control your emotions. At some point, the market will crash. It might drop 20%, maybe even 50%. And when that happens, every part of you will want to sell everything and get out. But here's what's interesting. The biggest reason investors underperform isn't because they pick bad stocks. It is because they let their emotions drive their decisions. According to JP Morgan, the average investor earned just 3.6% annually over the past 20 years, while the S&P 500 returned 9.5%. That gap comes almost entirely from panic selling during crashes and chasing gains during rallies. So if you can do nothing when everyone else is panicking, you are already ahead of most investors. And that ties into my third tip. Don't check your portfolio every day. I know it is tempting, especially when you have just started investing and everything feels exciting. But the more often you check, the more you will see short-term noise, like a 2% drop here, a 3% gain here. And the more likely you are to react emotionally and do something that you will regret. If you need to check, just check once a week or once a month, and that's more than enough. Lastly, you don't need to follow the news to be a good investor. You don't need to know what the Fed did, what tariffs were announced, or what the latest crisis is about. If you're dollar cost averaging into a global ETF, your only job is to keep buying and let compounding do its thing. Remember that green line from the beginning of this video? That curve only works if you stay invested, because the market rewards patience and it punishes those who try to outsmart it. If you want a deeper dive on which ETFs to pick and how to allocate by age, you can check out this video right here. And if this was helpful, like and subscribe. I post new videos on Singapore personal finance every week.